Are you unknowingly handing over your hard-earned money to banks without even realizing it? To stay ahead of the game and take control of your finances, be sure to subscribe to this channel for daily updates on personal finance, investing, and more. Having a budget in place is essential for efficiently managing finances, but with too many financial tools in the picture, it often becomes overwhelming and complicated. A good way to keep things under control is by opting for budgeting methods where expenses are categorized and broken down automatically, enabling you to regulate your overall spending more effectively. This approach tends to aid in taming expenses when they appear to spiral out of control, making it a crucial aspect of steering clear of problematic financial situations. And if you're serious about achieving financial freedom and want to discover the steps to financial freedom, start now and transform your mindset. I give you a present at link in the pinned comment. And most important, be sure to watch until the end of this video for actionable tips and strategies. Being aware of the often overlooked hidden fees charged by financial institutions is vital. You must assess all the available options carefully and not overlook promotional deals for certain bank accounts designed to attract new clients. Researching and evaluating these options meticulously allows you to better comprehend what you can expect and make a more informed decision. Your bank may require one direct deposit in order to open a free checking account, whereas some institutions might not impose this rule initially, but instead bring it in once you have a few months' history of utilizing their services. It is crucial to keep this in mind and consider alternative options if these requirements pose difficulties in your future financial endeavors. If stringent savings and minimal spending are high on your list of priorities, having a savings mindset that avoids future dependency on external assistance may influence your decision in choosing a bank. Researching the options extensively may not be your idea of an enjoyable afternoon. However, spending a bit of time to carefully understand each option will have a significant impact on your long-term finances. Take into account services rendered, fees levied, online banking limitations, any potential issues you could run into, as well as several small elements that may sway your choice when comparing two very similar banks or financial services. Most customers often ignore such crucial facets of banking services, mainly because they might not pose major inconvenience at the very onset, but when problems arise in future, this entire viewpoint transforms, usually proving you did overlook significant indicators. Remembering these elements is as critical and simple as remembering various safety aspects, such as having security programs on top of keeping details of account online, as merely one issue arising from unkept finances raises concern and has a potential to spread unease due to unexpected events, thus knowing that your monetary details at all times stay secure. Maintaining long-term stability in personal finances requires understanding little-known banking fees and terms. Some banks restrict spending, while others usually waive monthly charges, forcing consumers to operate within limits set by fees, resulting in huge disparities over course of time expenses. Maintaining strict budgets can provide vital clues in bringing up better offers from nearby or competitor institutions, when better circumstances then require transfer fees charged into changing these. When it comes to loans or credit cards, the way interest rates work can seem complex and even deceitful. It can result in you owing much more than you borrowed initially. Moreover, when opening an account, banks may tout their minimal or no-fee policies, but often neglect to mention their requirements for maintaining a minimum balance to avoid these fees. Not adhering to these conditions may even attract additional fees. Did you know that you could be earning significantly more interest on your savings than you currently are? Banks often promote their standard savings accounts as a safe and secure way to grow your money, but they usually offer meager interest rates that barely keep pace with inflation. However, other savings options like high-yield savings accounts or certificates of deposit, CDs, can provide higher returns without taking on excessive risk. In particular, interest-bearing accounts can also compound interest frequently, often on a monthly or daily basis, which can lead to significant earnings over time. The difference in earning potential between standard and high-yield savings accounts should prompt individuals to carefully weigh their options when selecting a bank or financial institution. Carefully evaluating terms and conditions, in addition to considering interest rates, can help you avoid common banking mistakes. These errors often stem from the fine print and usually result in lower returns or higher costs for services. For example, if not managed correctly, Overdraft fees and other charges associated with accounts can easily surpass the interest you earn on your savings. Furthermore, understanding that banks may employ different methods to calculate compound interest is essential to smart financial decision-making. Therefore, being knowledgeable about these nuances and researching alternatives when necessary can help ensure that you are receiving the most out of your money. Some banks might encourage account holders to make use of their financial services, including bill pay, direct deposit, or online banking. These benefits can certainly make account management convenient and time-efficient. Nevertheless, it is crucial to consider whether these perks serve to compensate for limitations like lower returns on savings. While this often affects customers passively settling for standard savings accounts, individuals who exhibit assertiveness in pursuing their financial goals usually enjoy better returns and greater overall financial satisfaction. To become educated and informed customers, we should thoroughly examine fee structures and conditions associated with various accounts and regularly compare offerings across institutions. While conventional wisdom may hold that higher returns inherently imply increased risk, this assumption does not hold true for all savings options. On the contrary, carefully managed savings accounts or CDs offered by established financial institutions can provide better returns without risking assets. When exploring opportunities to increase returns on savings, research can prove integral to the financial decision-making process. Gaining insight into fee structures, account requirements, and interest rates can mean the difference between merely preserving funds and seeing returns on investment increase over time. An in-depth analysis of banking products can further yield cost savings as more favorable options eliminate certain charges. By leveraging a better understanding of financial products and services, savvy account holders can successfully increase the buying power of their money and reduce costs. Assessing risk tolerance and avoiding emotional bias can be crucial for investors, particularly during periods of market volatility, where short-term fluctuations may prompt knee-jerk reactions. Delving into alternative investment options that complement diversified equity portfolios is a viable strategy for mitigating such risks. A critical examination of various market indicators and metrics can also provide valuable insights, highlighting the importance of fundamental research techniques in informing judgments. This is especially relevant in today's fast-paced and highly competitive markets, where misleading signals can be an ever-present hazard. Savvy and experienced analysts can offer valuable guidance, but it is essential to consider both the publicly available market metrics and some of the lesser-known intricacies that exist. By paying heed to both of these aspects, investors can eventually develop the skills to apply rational judgment, even in the midst of turmoil events. The key here is to maintain a flexible approach, one that acknowledges the inherent risks and uncertainties that come with investing in equities and other assets, where the actual degree of risk can change rapidly. Drawing connections to this area is the role of banks in managing our finances, an institution we often rely on but rarely question. While banks indeed provide essential services, it is vital to acknowledge that they are profit-driven entities that prioritize their interests. This reality can sometimes lead to the use of tactics that maximize earnings, occasionally at the expense of customers. For instance, banks often structure their fees in complex ways, charging for an array of services, including account maintenance, transfers, and ATM withdrawals. These fees can initially appear insignificant but accumulate over time, potentially eroding savings. Moreover, the types of interest rates banks offer can also be nuanced, with some accounts providing higher returns than others. However, banks are not always forthcoming about these details, emphasizing the importance of being aware of the intricacies of banking. Market downturns, in particular, can highlight the nature of this intricate relationship between banks, customers, and the broader market. When markets are under stress, banks may experience higher levels of credit risk and other financial strain. Consequently, they might tighten lending standards, increase fees, or adjust interest rates, all of which can impact customers' financial situations. Investors who understand this delicate dance between banks, market dynamics, and customer needs can develop more robust strategies to navigate periods of turbulence. Furthermore, by paying attention to monetary policies and how they are implemented, individuals can better anticipate and adapt to changes in the market. For example, expansionary monetary policies might stimulate economic growth, but can also contribute to asset inflation and market risk, while contractionary policies may stabilize prices but trigger recessionary conditions. By acknowledging and understanding these dynamics, investors can enhance their ability to apply rational judgments in tumultuous times. This interplay between market forces and banking practices underscores the importance of continuous learning and adaptation for investors and individuals alike. Recognizing the dynamic nature of market risk and how it can shift rapidly is essential for making calculated risk assessments and executing necessary actions. Moreover, it emphasizes the need to diversify investment portfolios and cultivate a well-rounded understanding of economic principles and market dynamics. Investors who can strike a balance between knowledge, experience, and adaptability tend to exhibit a more composed approach to investing, often avoiding common pitfalls that lead to financial pitfalls. The Fidelity studies finding that the S&P 500 has consistently outperformed traditional savings accounts over the past several decades demonstrates the importance of considering various investment vehicles when constructing a portfolio, including real estate investment trusts (REITs) in your portfolio can help minimize losses in volatile markets. Investing in a diversified portfolio that includes a mix of low and high-risk assets can also help you ride out market fluctuations, and building an emergency fund that can cover 3 to 6 months of living expenses can provide peace of mind in the event of a market downturn. Having a long-term perspective can be beneficial as well, since the S&P 500 has historically trended upward over time despite experiencing temporary setbacks and short-term market fluctuations. Maintaining a sufficient income stream from dividend-paying stocks or bond interest can provide stability to offset market losses. Managing expenses, reducing debt, and boosting income can be prudent strategies while navigating the waters of market uncertainty. Establish a monthly budget that details projected income and expenses and identifies opportunities for cost reduction or elimination. Reducing unnecessary spending on luxury items can result in significant savings, especially for those on fixed incomes who are more vulnerable to market volatility. Those in higher tax brackets would find tax loss harvesting an attractive tactic. This entails selling losing positions to offset gains on other holdings. When the dust settles, it is advisable to rebalance and diversify portfolios back into an optimal target mix. Furthermore, cultivating a deeper understanding of one's risk tolerance and investment goals can facilitate more informed decision-making, ultimately leading to improved portfolio resilience. Investors may also find it useful to leverage the concept of the behavior gap to inform their decision-making. This refers to the discrepancy between potential and actual investment performance, often resulting from emotional biases and impulsive decision-making. Implementing dollar-cost averaging strategies can potentially help average out volatile price fluctuations, thereby mitigating the impact of such biases. Similarly, maintaining a consistent investment schedule, rather than attempting to time the market, can also contribute to improved long-term returns. Moreover, recognizing and addressing any knowledge gaps or misconceptions can help investors make more informed decisions and avoid costly mistakes. Understanding market history has provided useful insights and often offered valuable context for assessing whether an anomaly could represent a buying or selling opportunity. By acknowledging historical precedent can also alleviate unsubstantiated and costly emotional biases, allowing investors to approach market fluctuations with greater objectivity. Implementing stop-loss orders can help mitigate potential losses, especially for those unfamiliar with navigating volatile markets. Moreover, keeping abreast of market trends, economic indicators, and earnings reports can facilitate a more nuanced understanding of market dynamics, enabling investors to make more informed decisions. Regular portfolio reviews, ideally on a quarterly or semi-annual basis, can also help investors stay on track and make adjustments as needed. During periods of heightened market volatility, it is essential to remain vigilant, yet avoid making impulsive decisions. Avoid overreacting to short-term market swings, as this can result in lower returns over the long term. Instead, investors should cultivate an informed, yet detached perspective, focusing on their long-term goals rather than short-term market fluctuations. Those with a solid grasp of the underlying fundamentals driving their investments are better equipped to weather market turbulence, adjusting their strategies as needed to ensure alignment with their objectives. Moreover, Fostering open communication with financial advisors or confidants can facilitate fresh perspectives, contributing to enhanced portfolio resilience and improved investor confidence. In a similar vein, do your research when choosing a loan or credit card. Always compare different offers and read the fine print to get a comprehensive understanding of the terms and conditions, particularly the interest rate and associated fees. Avoid using credit cards for purchases you cannot afford to pay back within the billing cycle. Implementing these strategies can lead to significant savings over time and allow you to maintain more control over your financial situation.